Well, thank you everyone for joining with me this afternoon for today's webinar. My name is Bob Lang with explosiveoptions.net. And just about once a month, we do these webinars where I get to sit back with you guys and talk about markets and trading and any particular topic that's on my mind that I want to teach you guys, or sometimes we have a great guest. Today, it's just going to be me. So I'm happy to be with you today. Just before Thanksgiving, it's been an interesting year to say the least. Lots of mixed movements, lots of volatility, and that happens to be the topic of our main discussion today, talking about volatility a little bit later on. So before we get started, just a quick couple of quick notes here. We'll probably be going for close to an hour tonight, and if you have to leave early, no problem. I'm going to have the webinar recorded right now, and it'll be up on the website in a few hours. Also, if you have any questions for me, go ahead and open up the questions box. Some of you already opened them up already. And any questions for me on anything that we're covering, just go ahead and blurt it on out. Just type it in there. Don't wait for me to ask you to ask a question. Just go ahead and type it in there, and I'll go ahead and answer it. If it's something that's relevant to what I'm talking to at the moment, I'll go ahead and stop and talk about it. Otherwise, we'll hold it for the end of the show and then talk about that and hopefully answer your questions. And then finally, if you have any technical issues, anything you can't hear or you can't see the screen or something like that, some internet difficulties, whatever, you probably just want to step out of the room, close your window, step out of the room, and come back in. That should probably solve any issues, any problems that you may have. So with that, let's go ahead and get started here, guys. Can everybody see my screen? Everybody see the S&P 500? Raise your hand if you can. Raise your hand, or else just say, type in yes. Open up. This is a good chance for you to open up your questions box. Go ahead and open up the questions box and type that in. Yes or no. You can't see. That would be great. Stephen can see it. You guys can all see it. Okay, good. Perfectly. Okay, great. All right. You guys are awesome. Okay. So what we've had here, some people would call it a melt up, I guess. Let me go ahead and let's annotate the chart here. So we see we have the S&P 500 chart on right here, right? And you can see we've had quite a moonshot here from the lows in early October. Let's call it about 28.48, 28.47. Right here. Actually, parabola up there. Right here. Okay. So we've had quite a move here of about 240 handles, almost 8.5%. From the lows in October to where we are right now. Let's call it about 30 days, right? Roughly something like that, 31 days. It's quite a move for a short period of time, but we've seen it happen before, haven't we? Anybody remember this move right here? Oh, yeah. Look at that. Big shot there, right? Right up to the old highs. We came up here, we tested it up here, and then we got clobbered in August, right? So June and July covered all that, right? Now, you know what? Listen, you know what? I'm not here to tell you. Change that there. I'm not here to preach whether it is the right move or the wrong move or not. That's not my job. My job is to look at the conditions in the market. My job is the same as your job. Look at what is happening in the market and the conditions in the market, right? And so let's isolate on this area right here, okay, for a minute. Let's isolate on what happened over here, right? this is pretty important because you could certainly argue for a inverse head and shoulders pattern. I'm looking at you, Justin. Right? We can certainly argue for that pattern, right? And then breaking that neckline, and we're into that area where we've taken off. So, if you want to layer, what you do is you layer that on top of here to figure out what the expected move would be. Let's call it, well, let's say 28.80 on the conservative side up to 30.24. That's 100, call it 144 points. So 144 on top of that, 30.24 brings you about 31.60 something or another. So I mean, it could certainly be playing out a little bit further based on this inverse head and shoulders pattern, right? But what I want you to focus on is this: is the amount of selling that hit when the market started to really come down at the end of September. There's some really heavy selling going on here. How do I know? Look over here. Look at some of these bars. Look at some of these bars are really, really heavy, concentrated selling going on. All right. Flushed a lot of people out. And if you recall, around the beginning of October, maybe the first week of October, sentiment was steeply bearish. The AAII, individual investor survey, was at near multi-year lows for the bulls, multi-year highs for the bears. The individual investor, the institutional investor, the II, which actually came out today, was also, which is a much slower moving sentiment indicator, was also flashing heavy bearish sentiment. Weather vane is another one that was also flashing pretty bearish sentiment. So the ingredients were there if we had made a higher low on the chart. And as you can see here, picking out my pen here, see here that happened, that actually occurred. Let's change the color there. Okay, as you can see, we made a higher low on the chart. So we were safe. So at this point in time, sentiment is pretty bad. We've made a higher low on the chart. We've had some pretty good selling that happened in September. Okay, everybody was scared about September, and they were right. Although we did start up higher in the early part of September, first couple of weeks, and then it was the last couple of weeks where we got clobbered and into the beginning of October. Okay, came down, tested that low, nearly tested that low, and it's been almost straight up ever since. I'm not telling you anything you don't already know. I feel like I'm just reading you yesterday's newspaper, right? You already saw the news, and I'm just trying to summarize what might have happened and try to crystallize things for you as to how and why it occurred. Because I know during the trading day, when we're in the chat room, you know that we don't have time to discuss these things. This is why we do these webinars outside of trading hours. I don't have time, neither do you, to try and rationalize the movements in the chart and try and put reason for the moves. That's not going to help us make money in that precious 6.5 hours that we have during the trading day. It does help us right now to give us some context as to how the markets moved and why, and come up with a rationale and say, oh, okay, I see, I get it, I understand. All right, now what's my next move, right? So as we came off of these lows here in early part of October, we just kept rallying, and then we had this big, huge gap up here. Remember that gap up? That was the one that occurred when it appeared that the U.S. and China trade talks were going well, and that was a time that I said, you know what, that was good enough for me. We gapped above that 20-day moving average, which actually at the time was moving lower. All right, because of the prior mess at the end of September, beginning of October. Okay, and we kept up there and stayed up there for a couple of days. And actually, the important day is right here. Important day is right here. Okay, that day right there was a higher high and a higher low on higher volume. So let's call it, I'm not sure what day that was. It looks like it was the 15th or 16th of October. And that was enough to put us over the edge here, if you were bearish, that is, put you over the edge and say that's enough, throw in the towel, okay? Because sentiment was starting to turn. The chart was starting to look very, very, very strong. We had some down days, but they were pretty light and pretty shallow in terms of price action. The volume was pretty low. And then these last, couple of last week and a half, you've seen the volume really starting to expand, right? Look at that. Okay. I know there've been a lot of complaints about volume levels. I know breadth has not been all that great for the best part of past couple of weeks. It hit record highs a couple of weeks ago, but what do you got to do? What do you expect? We've made a humongous run for the past 4.5, 5 weeks. You got to understand that the market's going to take a little bit of a breather, right? It doesn't necessarily mean the trend is over. It certainly doesn't mean it by this indication of this chart, okay? We realize that we understand, okay, that overbought can stay overbought for a long period of time. And even when we pull back, you can get good opportunities. I'm going to show you a couple of examples just on this chart here right now, okay? So we're overbought over here, right? Anybody want to raise your hand and say, and call the top and say, that's it, we're done going up? I doubt it. You'd be foolish to do that, right? Let's look back over here. Look back in this time frame over here, right? And notice that what's interesting is that you had an opportunity to get in when the market dipped right there. Okay, now it's right over here, popped right up, and then we fell, right? But it was once we fell through, it was sayonara. It came down really, really super fast in August, right? So I can't predict that's going to happen. Neither can you. So you know what? I'm a momentum trader. I'm a swing trader. I'm a trend trader, whatever you want to call me. Okay? I'm going to stay with the trend for as long as it's going, period. End of story. Am I going to have some protection? Sure. I had some protection coming into today. I took it off. It wasn't working today. I may apply it right back on tomorrow if things start to get a little bit dicey. We get into a no bid market. Bonds are up. Gold is up. Volatility is up. The futures are down or something. If that happens tomorrow, okay, yes, I'll be buying some protection and buying some puts. What were we doing today? Everybody in the chat room, what were we doing today? We were selling, doing some selling, cutting some positions off, right? Because that's what we do, right? Raising cash, taking short-term positions off the table, taking even long-term positions off the table, right? Getting ready for the next move. We know there's going to be a whack or somewhere around the corner, right? I guarantee you there's going to be a huge whack day sometime between now and Thanksgiving that you're just not going to be able to catch up to. You're not going to be able to add puts into that whack. You're probably not going to be able to sell your calls into that whack. Okay? So on a day like this, if you're pretty much long the market, if you're bullish on the market, today and yesterday were great days for you to unload stuff, unload some of your inventory. Remember, we're in the moving business, not the storage business. Isn't that right, TJ? TJ, we talk about that all the time. Leanne, Larry, Chris, Christopher, Bert, Andrew, everybody in the chat room. Kimberly's new in the chat room. Happy to have you here. Sam, We talk about that all the time in the chat room. We're in the moving business, not the storage business. And what that means is that our job is to try to find the good ideas. Hopefully things work out and we have some nice profits, right? And then we move the inventory. That's all we do. We pick stuff up, we let it work for us, make some profits, ship it right out again. That's all we do. That's what our job is, right? So that being said, where does it look like we're going to go in this market here? Sorry for all the lines over here. I mean, we could certainly go in any number of directions. We can pop up here for a little bit longer, maybe up to 3,100. Larry McMillan, who I follow quite closely, is a good friend of mine. I've known him for about 12 years. I read his stuff every single day. He's a brilliant options guy. He's been around since the beginning of time. So Larry's got a target of 3,104 on the S&P 500 on the total put call ratio, which is the put calls are getting pretty low now as we talk. They're getting pretty low on the chart. And when they do and they turn right back up again, there's going to be a sell signal. The VIX is still low, 12.73. And as he says, as long as the VIX is low, the markets can continue to rise. They can rise as long as the VIX is low. It's not a problem for the markets if the VIX is low to be able to go up, all right? We'll have more shout. If the VIX starts to rise, say up to 16, 17 or something like that, then we have a problem if you're bullish, right? So we could go up this way. We could come down a little bit to test this breakout level and then move right back up again right after that, okay? So we could go in a couple of different directions. I don't think we're going to break down too much. I don't buy that. Look at this super strength that is in the relative strength over here. I mean, this is just super impressive over here, right? You've got money flow that they were kicking and screaming to get back into the markets, okay? Kicking and screaming to get back into the markets, but ended up when we were negative in October, all right? And hold on one second here. Sorry, somebody texting me. Anyway, we had some people kicking and screaming trying to get into the market, and we ended up turning money flow positive again, which was good. Right, you can see that right over here, okay? And, you know, by and large, the internals have been pretty good over the past, you know, 3.5 weeks, right? Not to the extent that people have been trying to get out of the market using these higher prices to get out, right? I'm going to show you another chart here in just a second. I'll save that. Kind of a messy chart there, so sorry about that. This is a chart that I put up for EO charts yesterday, and a lot of you guys should be familiar with this one. Everyone has seen this one before. This is the new highs, new lows index. Now, I talked about this yesterday in the, I'm sorry, the day before yesterday in the EO charts talk. And basically what this tells us is the strength and the health of the markets at extremes, all right? It's really super important to pay attention to new highs and new lows at market extremes, right? And so would you guys agree? Raise your hand if you guys agree we're at a market extreme right now, or extreme highs, right? So I want to look at this indicator and see how healthy it is. Because if you go back to last year, last September, in early October, just a little longer than a year ago, we were making new highs in the market, but this indicator was taking a nosedive. Let me see if I can. Doesn't quite go back that far. Let me put it down over here. This might be a little bit better here. Okay, yeah, so October. Oh, I said September, didn't I? Let me change this one more time. Here we go. Okay, so back around September, late September, early October, markets were making all-time highs, right? Yet this, you could see the dangers here as this thing was breaking down, right? And then we had this really big day in October 10th last year, where the Dow was down 900 points. I think the markets were starting to react and respond to a too much of a restrictive policy by the Fed. They raised interest rates in October, then they came back and raised interest rates again in December. Everybody remembers that. Remembers what happened here in December. This is not the markets. This is the new highs, new lows, right? So we saw new highs plunge and new lows completely swamp out all those new highs, right? New highs were minus 1,200. Levels we hadn't seen since the financial crisis in 2008, 2009. So this was a good warning flag. Now compare that to now, right? We don't really see those warnings going on right now. This is actually the breadth, the new highs, new lows is actually really healthy right now, right? We did hit some levels, some pockets, air pockets here in June and July. We did hit some high levels on those some of those days, and we did pull back in early August. But the pullback was rather shallow. It wasn't anything deep like we had in October and even late part of November and then early December in 2018. So I don't really think that this is too much of a material drop over here. It's just more of your corrective type of a drop, and even see it in the relative strength over here. We got really deep low levels here in the RSI, and we didn't really get too deep in those levels in the new high, new low indicator earlier in the year. So this is very healthy. This is one of the reasons why I don't think that unless there's some exogenous event that happens, we don't know, that could whack markets out. All of a sudden the China deal is off. Something out there that we don't know about, right? Let's call it the black swan event, right? If there's something out there that we don't really know is going to hit the markets, we could certainly have protection on, but at this point in time, to have too much protection on is probably not a smart thing to do. We've seen gold come down. Gold's down to 1469 right here. Silver's come down a little bit. So it's pretty much been a risk-on environment for the past few weeks. Certainly since that since the U.S.-China deal was consummated, phase one or something like that. And so today we saw some more positive news that came out related to that, related to tariffs. So, I suppose when they sign the deal, that might cause a little bit of selling on the news, who knows? But in any event, I think the markets are in pretty decent shape over here. Hopefully not going to make me eat my words. That could always be the case, but we'll kind of have to. Here's the NASDAQ here for you. Let's take a look at that. New all-time highs, and again, much like the S&P 500, once we broke out over here, over that old high from back in July, it's just been higher highs and higher lows, a little stair-step pattern over here. Could we use a breather? Sure. Maybe back to the 10-day moving average, which is right over here, 81.35. Maybe the 20-day moving average brings you down to 8,000. We'd bring down to about 270 points. We could do that in 1 or 2 days, right? Come back really sharply and freak everybody out, right? But we like we had over here, or like we had over here, right? We had a couple of days where we did fill some of these gaps. We had one huge gap up and down over here. It was around 7,700, and eventually that's going to get filled, but it may not get filled for another month or two. Who knows, right? We're in a seasonally strong period for equity markets right now. So, however, I will tell you, maybe not a lot of people will tell you this at all about. So I got this question just a day or two ago. They said, Bob, how about when do hedge fund managers, investors, basically throwing the towel to the end of the year. And we're probably talking about the middle of December until the end of the year. You won't see a whole lot of that going on. Now, obviously, last year was kind of an anomaly. We had a lot of selling going on, and then we had some repositioning of asset allocation towards the end of the year, and there was a lot of money that was allocated, reallocating out of bonds, out of fixed income into equities. And that sort of started on December 26th, right? So there was a lot of buying coming on right after Christmas last year. If you remember some of the erratic price action, and we said we would start off down and end up really, really strong at the end of the day with some really big ticks and so forth, and volatility was dropping. So anyway, I would say by and large, by the 13th, 12th, 13th, and 14th of December, you're going to see things starting to slow down a little bit. You'll see a lot of the volume starting to subside, and you see a lot of the action starting to become much more erratic. It's at that time that I would suggest and highly recommend to you to play it lightly into the beginning of the year, and and as we talk about the beginning of the new year of 2020. All right. If we haven't corrected in too much in December, expect that to happen probably in the first 2-3 weeks of January. And if we don't correct in January, expect that really big correction like we had 2 years ago to happen in February. All right. So be on guard for that. I just want everybody to be careful here. I mean, we're in a point in the markets right now where you can easily get hurt. If you got both feet in the pool right now, you can get locked in and get whack-a-mole'd like you wouldn't believe. Okay, I've seen it happen. I've been through it before. So I would just tell you, as we come into the end of the year, whether you've had a really good year of 2019 or not, it doesn't matter. All right. You don't want to get clobbered. You don't want to get hit in the last couple of weeks of the year, where price movement is, again, super erratic. Lots of people stay away. They're not trading. You don't get a lot of liquidity in the markets that we normally do during the year. And it becomes a very dangerous environment. Okay. Trying to get in and out of trades it becomes very, very difficult. So that would be my advice to you. So that's that. So I hope everybody's doing well. Give me some feedback on how you guys are doing. What do you think about the markets right now? And kind of just open up your questions box here and let me know what you think here, huh? Go ahead and hit your thing. Do you guys think market's going up, down for the rest of the year? You guys been making money? What have you been doing? Jason says the VIX Bollinger Bands are squeezing tight. Let's put the VIX up here. I'm going to talk about volatility in a minute. That's good. Good question here, Jason. Let's see here. They're starting to tighten here. That's right. It's kind of, you know what, as far as the scale is concerned, it's hard to interpret this over here because we're up to 24 over here. Let me take this down a little bit here. Yeah, there you go. And you can see those bands starting to tighten up here. So we're at 14 on the top, coming down really fast. We're at about just under 12 on the lower band, and we're coming up tight. So yeah, so you got resistance coming in here on this upper band over here, and eventually it's gonna pop over here like it did over here, right? We had the band starting to tighten it at the end of July, and we had a big, huge spikes in August over here. So I would say this, because we're going to talk about volatility in a little bit. I will tease you a little bit and say that I think it'd be a good idea to take out some rental insurance on some volatility here over the next month or so, right? With the VIX being 12.7, you can buy some puts on the S&P, some at the money puts going out 3 weeks, whatever. Let's just price these out for a second here. So the SPY, let's see here. Let's say you went out to the on the SPY, let's say the 27th, right? Since the Wednesday before Thanksgiving. I mean, you could buy some. So we closed at 308. We're at 308.40 right now. I mean, you could buy some 308 puts for about 260. Probably tomorrow they'll be about 245, 250, right? And what is that? What is as a percentage of the index? It's less than 1%. It's what 80% of the index, 8.8 0.08% of the 0.08% of the index is less than 1% of the index. It's very, very cheap. You can even go to the 20th, the week prior to that, right? It was the Wednesday prior to that, which is you could buy like some 308 puts for probably about $1.80 tomorrow. 308 puts for $1.80. So I mean, let's say we correct back to 300 on the SPY, or let's call it 3,000. Or maybe even 3,020. We can correct 60 handles, which is 2%, right? You can correct 2% in the next couple of weeks. Would anybody be surprised? No. So a 2% correction takes you down to 302, and those puts, if you bought it, say at $1.85, would probably be worth $6. Okay, and it's just cheap protection. So I mean, you can buy, say, I mean, I don't know if you have, let's say you have $50,000 worth of calls in your portfolio, and maybe you're sitting on $50,000 in cash. You got a $100,000 portfolio. All you really need to do is say buy 5 or 6 puts, or 7 puts. Spend $1,000, maybe $1,500, and then maybe buy some QQQ puts, right? Qs are at roughly 200, right? 200.43. They're going to be a little bit higher tomorrow. You could buy some November 22nd 200 puts for about the same price as those SPY puts we're talking about. And let's say you get a 2% move down there. The 2% move down is going to take you down to about 196, 195. And those puts would probably be worth about $4.50 to $5. Okay, so I mean, maybe again on a $50,000 portfolio, you maybe buy 5 or 6 of those SPY puts for $1,000, for between $1,000 and $1,300, and then maybe buy 6 or 7 of those QQQ puts for about the same amount of money. You've paid $2,500 to protect $50,000 worth of options. So what is that? 5% roughly. And if you've got a whole bunch of cash, there you go, right? You could pay for those puts by a little move up in the market, incremental move in the market, right? But if the markets do correct, and we know it's going to happen sooner or later, right? Those puts are going to really build up in value if the market comes down, even just close to 2.5%. So think about that. Does anybody have any questions on that? Let me see here. Sam says, I think new highs are coming. I kind of agree with you, but we could pull back a little bit. Fear and greed is up there. Larry says, Tat says, never let your guard down. Jason thinks that pop is coming. Chris Stanton says, I think a short correction is coming, but I've got major FOMO. Glenn says, I'll be very happy if the trade wars are fading. Me too. Markets are going up, money flows into stocks. Few strategic plays. Len right now, that's by Sam. Shree says, so Bob, by 3,100 on the SP, we should be moving to cash. Again, it's not that simple, Shree. Okay, it's not. You got to play things as they are. I mean, you could have been going to cash a few days ago, a week ago, or something like that, right? So you got to. There's no perfect timing on these things, right? Got to have a good feel for it. And right now, I think with the VIX where it is right now, you've got to understand that the odds are going to favor a rise in volatility eventually, probably within the next couple of weeks. Justin says down short term, shakeout, and then a higher. Keep your eye on the VIX. Yeah, volatility index, the volatility of volatility, which is the VVIX. Not doing too much right now. It's about 90 right now, so it hasn't started heating up. Steven says, I expect uncertainty in the markets, so I'm trying to find a strategy that works. Glenn says he's going to be happy tomorrow. Disney's looking good. Yes, it is. And then Bob, what expiration talking about on the SPY puts? You know, Steven, the one I mentioned to you is probably like the November 20th, right? So I'm only talking 2 weeks away from today or from yesterday. You know, 2 weeks away for $1.80. Again, 5 or 6 of those for, you know, and again, the case study that I was showing you was, say, for a $50,000 portfolio of options. Let's say you had a whole bunch of options, you got $50,000 worth to protect, and then maybe you got $50,000 in cash. So let's say on a $100,000 portfolio, you're 50% invested in options, different strikes, different stocks, different names, right? So what you want to do is you want to protect that, and you can protect it with maybe 5% of your total option position. So if you have $50,000, you can protect all that for about $2,500, right? Now, you're probably not going to lose it all. You shouldn't lose that all. Let's talk about the $2,500, right? It's insurance, right? And I'm always buying some insurance. I'm always have some puts going out as losers, right? But you've got to be able to look at the situation, look at the conditions, look at the S&P 500 chart one more time. Look at the SPY chart one more time, right? Look at that. Okay? I'm not trying to time the market here. I'm not trying to call a top. All I'm simply trying to do is recognize that the markets don't go up every single day. They're not like trees growing to the sky. Okay, the market will come back. It'll correct. Okay, I heard a lot of people back in June and July arguing with me. I don't need protection. We're going straight up. You know what? There's going to be a China deal going on. Why do I need to buy protection? Well, it's because look what happened in August, right? And then look what happened in September. Okay. We could come back 2%, and you're going to feel like the sky is falling. The world is coming to an end. The S&P 500 drops 2%. That's 60-something handles, 63 handles. Okay. Back when it was 2000, that's 3%. That's a big move. Back when the S&P was 2000, now it's 3000. Doesn't seem so much, but it does. It's going to be painful. It's going to hurt if you're long calls. But if you're not protecting yourself, it's really going to be painful. If you have some protection on, at least you're helping your cause a little bit more. So let's see here. Jay Steven says, I expect those pullbacks, half-hour expiration. Do you normally recommend? You know, I usually go a couple weeks out. Steven maybe likes it on these things. If you want to go further out, I'd probably take a couple of months, maybe get out to January or something like that. I don't think it's necessary right now because future volatility is not all that cheap. Okay, go out to January. The VIX term structure is about 17 in January, close to 18, 19 in February, March, and April. So if you buy puts out into January and beyond, you're paying up for them, right? It's the short-term volatility that you pay for protection, right? Because if this thing goes up, this thing is going to go up a lot more than these are going to go up. And where do you make money when the S&P goes down? When you buy puts, you look at this term structure. Okay, it's these things go up in the short term the most. Okay, if you're buying January, February, you need these to go up a lot, and they're just not going to go up. You have more chance of this curve flattening out than you have of all these rising. From where we stand right now, from a seasonality standpoint, okay, there's been a constant bid in this market for the past 4.5 weeks. There's been a bid in the market. Am I wrong? Am I right? There's been a strong bid in the market for the past month and a half. And I'm not saying it's right. I'm not saying it's wrong. We are not here to judge it. We're just here to see it, identify it, recognize it, and try and take advantage of it. Okay. So a couple more things here, a couple more questions. You guys have come up with really great questions today. Sam says, nothing surprises me anymore, but the new high chart looks very good. ISEE readings pop 2-to-1 calls to put rear reading. Okay, so I talked about that, Jason, the other day about the 2-to-1 calls to put. So let me show you an email that I got from a friend of mine, Fred. Okay. Okay. Oh, wait, hold on. Okay, Jason and everybody else, I posted this in the chat room, but it bears repeating here. So this is from yesterday. Fred Goodman's a good friend of mine. He writes a great newsletter once a week called the Market Monograph. So he goes, investors bought more than twice as many calls as they did yesterday, puts. This was on the on the 5th, which was Tuesday. Jason, that's what you were referring to, right? So read this, 2.4 times as many to be precise. The average over the 11 years has been 1.1 calls for every put. So this was an extreme reading of calls versus puts, right? So this has happened 6 times since 2008 to the last 11 years. And in 5 instances, the market moved higher in the next 20 sessions. There was 1 decline over those 5 times. I'm mean, 6 times. For a win ratio of 83.3%. So 5 divided by 6 is 83.3%. Actual 20-day returns were as follows. You can see that. In 2009, 2010, you had real strong returns. In 2009, smaller returns in 17 and 18. And then here's a chart that reveals the market continued higher to move higher beyond the 20-day period and 4 of the 6 events. You can see 1, 2, 3, 4. 1, 2, 3, 4 right here. Continue to move higher. So while it does make me a little bit uncomfortable to have that ratio there, it's all that giddiness coming into the markets, people buying calls hand over fist does make me a little bit uncomfortable. It shouldn't be considered fatal for the markets based on the evidence I just shared with you. Okay, does that make sense? Is that good, Jason? Okay. A couple more questions here. Christopher said, what about the impact of tax selling to consider as well? That's another point. You get a lot of tax selling, Christopher, in December. In the time frame that I was telling you, it was a good time to step back a little bit and be a lot less active. Right? Get a lot of tax selling coming in. With probably you're going to get a lot of energy names that stock people want to dump because that sector has just been obliterated. Any group that's been poor for the past 10, 11 months, you're going to see a lot of people just dumping names, dumping stuff, right? Getting into cash and waiting for the beginning of the year, or else getting into names that are doing well, right? I mean, maybe people are going to come in and say, look, you know what? I had a huge gain in the first couple of months, and Netflix really took off into February, March, and it's just been a dog since then. I'm going to get rid of it. And you might see Netflix pull back a little, right? Facebook as well, so etc. So you might see people starting to pile into Apple. Apple's been the leading stock for all time here for the past couple of months. You may see people piling into that name, and we might see Apple making a move up to 270 or something like that. So those things you have to be aware of. So good point, Christopher, talking about the tax selling. Don asked, you buy at the money? Yeah, when volatility is low, like it is right now, it means option prices are cheap. So why wouldn't you buy at the money, right? I'd like to buy higher deltas at the money, because if you, let's say we're going a couple weeks out. Let's say we're going to those November 20, November 22 puts, the Qs or the SPY, right? For a couple weeks of volatility, when the markets are pretty wild and moving up and down quite significantly. They haven't been. They've just been moving mostly up. But when it gets some movement there, those puts that I identified were are going to be $1.80, $1.90 tomorrow. They would be $4. It would be twice as much, maybe 50%, maybe $3.50 to buy some protection. So right now, buying that protection is cheap. Nobody's buying volatility right now. They're selling volatility. They're selling vol. Look at the move down in volatility. Look at the chart you're looking at right on your screen. They're selling volatility on the front end, right? Down 2%, down 1% in January, down 2.4 in December, down 2.93 in the front month, November. Pulling right down to volatility was actually up a little bit today, but it's pulling down the futures, right? So people are selling volatility. People are emboldened here by the markets making new highs and think that it's going to keep going on and hitting new highs. It may very well do that, but I think the odds seem to favor the fact that we're going to get a substantial pullback. Let's call it 2 to 3%. It's going to seem painful. Listen, 3%, that's 90 handles on the S&P 500. 3%, right? We pulled back more than 3% over here, right? 3.5%. Over here, we pulled back quite a bit, right? From 300 all the way down to 282. 7%. Seemed like the end of the world, didn't it? Okay. Shreya says, I have a question. Can you explain the math how 5% puts on $50,000 in call option protects at 50,000? So 20, I don't, what do you mean explain the math? I'm just telling you that the money you put up there is, all you need to do is to protect, say, $50,000 worth of options is about 2.5 to 3%. Because when volatility starts kicking up, you're going to lose value in your long portfolio, but those puts are going to gain value in exponentially higher. Okay. All right. Hopefully that understands that. Not enough time really to go into the math with you, but believe me, it's right. Okay. Like dancing. Steven says, there are rhythms and markets have them too. So even the markets will rise, they will also pull back. I think what you're saying is that you can benefit from the protection in the short term while pursuing new highs in the long term. Steven, you just nailed it. Thank you very much. Excellent comment. Jason, thank you. Christopher, thank you. Dan says, so the Fed's been pretty liable on cutting rates. Are you concerned at all about the next meeting? I'm not really concerned about the next meeting, Dan, because I think that this last meeting, I mean, listen, anything can change, right? It's all fluid. It's all up for grabs, right? And what we could do is we could certainly have the Fed spinning things a different way and saying, look, you know what, we're going to be in tightening mode now. I don't think that we're looking at that based on what we were told at the last meeting. But again, what they told us at the last meeting was certainly not expected after the July meeting was over. So, it could certainly, the September meeting and the July meeting, it could certainly change at the next meeting. I don't know, right? They're going to be paying attention to the data, as they've been saying for years and years. So let's see what happens. I can tell you this much, that, based on the data, they shouldn't be tightening anytime soon. And I don't think, unless we hear some comments as to such and see some strong inflation numbers, I don't see them coming in and raising interest rates anytime soon. Chris said, watching the board, I'm noticing more shorts, more buying puts on companies that I'd seen in the past. It's true. Is this an offset insurance against calls as well? Also, is this a divergence from the trend? Well, yeah, I would say so, Chris. But again, you've got to be ready for anything, right? And I'll go back to May, early part of May, where markets were hitting all-time highs, right? And then I didn't have very many puts working. And I think it was the Cinco de Mayo massacre this year, and he came out and said he's hitting China with right between the eyes with the tariffs, and the markets got belted. Not just that week, but all the rest of the month. And I couldn't catch up to it. Volatility back then was about right around where it is right now, 11, 12%. So I'm not saying that we're going to have the same sort of thing happen. Obviously, the dynamics have changed. They flipped around quite a bit from where they were back in May. So we may not have the same scenario, but you just never know. Something can pop up and to hit the markets right between the eyes. And with the S&P 500 up some 23% or something like that for 2019, why not, right? Why not correct the market till we can correct 10%? And the market still has had a decent year, right? Okay. Let's see here. Carl said could be too broad and out of scope by 12/31. Jim Rickards, SDR threat given the real market. I have no idea. I know who Jim Rickards is, but I have no idea what an SDR threat is. He's kind of a fatalist, isn't he, Carl? Don asked, do you ever buy ultra shorts? I don't know what ultra shorts are. Do they sell those at Target? I'm kidding, Don. No, I don't know. I don't know what those are. I suppose you're meaning the leveraged ETFs, like the 2 and 3x, 2 and 3x ETFs. I don't buy those at all. I get plenty of leverage with options. But those are really good vehicles to protect yourself as well. We have those in the trifecta. All right. Any other questions? So real quickly, I wanted to. I mentioned the volatility and how to take advantage of it. Right. What we have right now, we have conditions that are primed and ready with low option prices right now. You want to be able to put yourself in a position to not necessarily make money, but just not lose that much money. Right. And so that's why I suggested earlier. Adding some puts. And look, if you're wrong, just do what I do today. Just do what I did today. Justin was asking me earlier today, why would you sell your puts today? Well, these are not working. They're not working today. I mean, I get into them later on. I get on them at the end of the day today. I could buy some puts on Friday, right? If they're not working, why do I want to throw money away? The predominant trend, look at the market, look at the chart right in front of you, has been up, right? And while there could be some surprises here and there, again, we're in a seasonally strong period. Those sort of things don't normally happen. They can happen, but they don't normally happen. So we have to use some common sense here, right? Nothing wrong with having some protection on. I say it all the time, okay? I do have some puts on, not very many on, but they're not working right now. I may have to add some more tomorrow and over the weekend, just in case, right? And if I'm wrong, I'll cut them and I'll reload another day. That's just what we have to do, okay? Hopefully that makes sense. And remember something, okay? That the seasonality trends are good probably for another 5 weeks, right, to the middle of December, and then it looks like things are gonna quiet down a little bit. And like Christopher said, you're gonna get some of that tax selling going on. Some stuff has been working really, really well, right? I mean, the banks have been strong, home builders mostly been strong. We've had some good action in the technology names, semiconductor names have been pretty decent. Cloud names have been poor, but there's some pockets and some areas of strength here that we can certainly take advantage of. Earnings have been fairly decent by and large for the past 5 weeks since the earnings season started in early October. So use the volatility where it's at right now to your advantage. And by doing that, just being able to buy some cheap puts is going to do the trick for you. Okay. All right. So I think I'm going to wrap it all up there. probably were expecting a lot more about talking about volatility. There really wasn't a whole lot to talk about, right? Other than just saying that the volatility has been coming down, people have been selling it. This is a good time to be contrarian and start buying some volatility, right? Sam asked a couple questions over here. I like calendars in this environment. Me too. I had some calendars on Roku. Those short calls really work to lower some of the risk and some of the longer calls today. I had some also in Amazon. I still have some working in Amazon. When the market's volatility is low, the expected moves are pretty low. But when you get stocks like Amazon or Google that have really high implied volatility, even in the short term, you can sell that premium and take it in, and it's really a nice. It's really nice. So you can sell it in the short term, okay? Which, we were looking at this. This is exactly what this chart is telling you to do. This is exactly what it's telling you. Sell the front end and buy the long end. Sell the front long, sell it as it's coming down, okay? Sell the front end and buy the long end. Any insight and gathered by the Russell 2000? Okay, let's take a look at the Russell. Sam, I'll just put the IWM up there, if that's okay. All right. We've had some dark shadows the last few days. Maybe this is giving us a clue that the markets are pooping out here, getting a little bit tired. We could get a pullback to this 10-day moving average on the IWM, 157 and change, or something like that. 20-day moving average may be even better, but that's moving up, but it may meet up around 156 or something like that. A 2-point move down would only be just a little over 1% on the IWM. Why not? I mean, how about back down to 158, right? In the next couple of days, right? That's we reached past 160 here, not all-time highs. Past 160, we pulled back a little bit. That would be 4 points to the down. 2 points to the downside. I mean, 1.5% pullback. That seems to be what the market has been doing, been expecting here for the past several days. We had a little bit of a pullback over here. We had a bit of a pullback here one day, and pull right back up again at the beginning of November. Thank you, Sam. I appreciate very nice comments. Appreciate that. Do you follow Doug Cass on Real Money Pro? Sounds like he simply shorts into strength and buys into weakness, capture the rhythm. Sounds nice. Definitely not something I'm skilled at. Doug Cass is my colleague on Real Money Pro, and I'll just leave it at that. Can the market go up even if vol picks up? Yes, but unlikely, Samba, that that's going to happen. You have to understand something about volatility, right? Volatility, all it is just increases movements within a range. Instead of going up a small amount, it's going up and down a small amount, larger amounts, right? All right. So what? If you were averse to the pain of losing money, if you didn't care if you lost money or made money, volatility wouldn't matter, would it? If you were just decided making 5,000 as you were losing 5,000, would matter, would it? So basically, most people don't like to lose money. So when volatility starts to rise, you get bigger movements, and people see big moves down, they start to panic, and it becomes a self-fulfilling prophecy, right? That markets are going to go down. Make sense? Breaking news, Michael Bloomberg is going to enter the race. Oh, that's good. I like Michael Bloomberg. Thanks, Bert. Appreciate that. Everybody, volatility is higher, is better, is high. It's better to give longer term, shorter term in your opinion. Look, we always have volatility, right? There's always going to be people who are worried about markets, who are going to scared or to get in and scared to get out. So because nobody knows the future, right? So you have to realize that that sort of thing is going to is going to be with us all the time. Longer term, when you get big hits in stocks, like we had in 2008, 2009, it created enormous opportunities to make money. Bank of America was $3, it's $33 now. Ruth's Chris was under $1, it's 20 now. Las Vegas Sands was under $1, it's $63 now. So you get those opportunities there when volatility starts to spike, right? Okay, I'm going to wrap it all up. Thank you very much, Carl. I appreciate being with us. Don, Shri, Sam, everybody for your great questions. Samba, Christopher, and Jason, and Dan, and Chris. Thanks, everybody, for joining in with me. I'm going to have a replay of the webinar up tonight, and probably send it out to you a little bit later on today. If you want to watch it over the weekend, it'll be up on the website. Probably have another webinar next month before Christmas, and I look forward to seeing all of you guys then. Thank you again so much for joining in with me today. I hope you learned a little bit today about markets and about volatility and about things to do. But don't forget to protect yourself by adding some puts. Not going to hurt you very much right now with the volatility down where it is. So thanks again, everybody. Have a great day of trading tomorrow. If you're in the chat room, I will see you bright and early tomorrow. Take care, everybody. Bye.